events in the Ukraine continue to overshadow everything else and while this is nowhere near as important as what's happening on the ground, investors will be noting with some concern that the FTSE 100 is now down by more than 10% from its high, while the FTSE 250 is in bear market territory after a slide of more than a fifth from its peak of last September. Now, no one knows what's coming next, but these events can only serve to put an even brighter spotlight on policy meetings at two major Western banks that are due in the week ahead. The US Federal Reserve on Wednesday the 16th of March and the Bank of England on Thursday the 17th. How much influence their interest rate and quantitative easing or QE policies can have right now is a moot point. After all, neither monetary authority can print oil or gas or aluminium, copper or nickel, for example. In addition, inflation that stands at a near 30-year high in the US and a 40-year peak in the UK means that interest rate cuts or more QE or both are not really viable options this time around, even if they've been the standard tools of policymakers during every bout of financial market trouble, dating all the way back to the Russian debt default and collapse of the LCM hedge fund way back in 1998. Now, the lofty inflation figure suggests that interest rate rises would be the order of the day to rein in that inflation and stop it eating away at consumers' and corporations' real-term earnings, and thus their ability and willingness to spend, hire or invest. But worries that high fuel and energy and raw material prices could hit the global economy, just as they did in 2008, for example, mean that central banks could find themselves between a rock and a hard place and having to choose between letting inflation do damage to economy on one hand, or higher interest rates dampen economic activity on the other. There will be some who argue that the Fed and the Bank of England have brought this slightly upon themselves by leaving interest rates too low for too long. But then, whatever you think of that argument, there is a risk that Chair Jay Powell and Governor of the Bank of England Andrew Bailey do find themselves boxed in. Now, in the case of the Fed, markets have gone from putting more than a 50% chance on a half-point increase in the US to a 6% probability the Fed does nothing. Now, a quarter-point rate hike to a 0.5%, the first increase of this new upcycle, is still the consensus view, while the Fed is set to continue tapering QE so that it stops adding to the program as of this month. However, that means the Fed has still been growing its balance sheet this year, adding stimulus even inflation has been running riot. Total Fed Reserve assets are now running at nearly $9 trillion for the first time ever. The Bank of England's already squeezed out two small rate rises to 0.5% from their record low of 0.1%. It's also stopped adding to its £895 billion QE scheme, and Governor Bailey had begun to talk about shrinking the Bank of England's balance sheet and withdrawing some of the stimulus via quantitative tightening or QT. We shall see, but maybe that has become a slightly less possible prospect in the current environment. Now, on the corporate front, the reporting season for the FTSE 100 firms is drawing to a close, but plenty of mid and small cap companies that have a December year end will be looking to release their full year results by the end of March. The schedule is therefore pretty busy, although again note that some of these dates could yet to be subject to change. And names which may be worthy of note and further research include the following: Bodycut and Abcam on Monday the 14th of March, Ferguson, Informa, TI Fluid Systems, DFS Furniture and Ultra Electronics on the 15th, Boohoo, Centamin, Wagamama Owner Restaurant Group, Restore, Ferrexpo and Fever Tree Drinks on the 16th, Ocado, Trainline, Wix, OSB and Cineworld on the 17th, and JD Wetherspoon and Contour Global will close out the week on Friday the 18th of March. However, the company which could just cause the biggest fuss in the week ahead is Endeavour Mining. The gold miner, whose shares trade in London and Toronto, is due to release its full year results on Thursday the 17th. Now, the results should be interesting for two reasons. First, Endeavour is going into the FTSE 100 on the 21st of March, having just been promoted in the latest quarterly reshuffle, even though it only floated in London last June. Second, the gold price is holding pretty firm at around $2,000 an ounce, as investors seek out haven assets amid the uncertainty caused by the conflict in Ukraine. Another gold miner, Polymetal, well, that's just dropping out of the FTSE 100 because all of its assets are in Russia and its share price has collapsed. By contrast, Endeavour's mines are in Africa. It's got 7 producing sites across Burkina Faso, the Côte d'Ivoire and Senegal, and it's around the 12th largest quoted gold miner in the world on the basis of annual output. The shares are nearing a new high during their short spell on the London Stock Exchange, and they're also nearing a 5-year high in Toronto. When it comes to the numbers, analysts will home in on 4 headline figures. The first is output. January's trading statement revealed that Endeavour had beaten its guidance for 2021 with production of 1.536 million ounces of gold, a big increase on 2020, thanks in part to the acquisition of Semafo and the merger with Teranga. Remember, Endeavour also tried to merge with FTSE 250 gold miner Centamin back in 2019. For 2022, Chief Executive Sébastien de Montessus has guided to 1.4 to 1.5 million ounces, a slight drop in gold production, and it'll be interesting to see if he sticks with that, especially as there's been a military coup in Burkina Faso. The second headline number is costs. In 2021, all-in sustained costs, or AISC, came in at $880 an ounce, and January's guidance was for an increase of somewhere between $880 and $940 in 2022. Third headline number is profit, naturally. For 2021, analysts are looking for an operating profit of around $850 million and an earnings per share of $1.86. While for 2022, they're looking for a slight dip in the former owing to the increase in output costs and a slight increase in the latter earnings per share figure. And the fourth and final headline number is cash returns. Endeavour has a net cash balance sheet and it's just started to return money to its investors. The firm has already declared $140 million in dividends for 2021, equivalent to 57 US cents a share, and bought back $138 million worth of shares. Endeavour has announced plans for a minimum dividend of $150 million for 2022 and $175 million for 2023, with buybacks on top. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.